Traders, this is Rob Reinhold. It is a trading room, and here we are in the last week of September. Let's get into it. What we're going to go through in this session, we're going to go through a review of the previous week. There was a lot of news to digest. We had a lot going on. Pretty boring first part of the week, but a super exciting second part of the week. We are going to be updating our scoring system and our analysis. A lot of changes here. I want to go through all the changes to make sure everyone understands that we are no longer in a sideways market. It is confirmed that we are now bearish. And always, we are looking at trading setups and opportunities. We'll be breaking down some trades in some of the best sectors.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
Last week we had the big news of the FOMC statement. Now that came on Wednesday, so the first 3 days of the week, pretty boring. Even on Wednesday, there was a little bit of selling, but then boy, it really cascaded on Thursday and Friday. And we broke lower here. Now, what the Fed said was that they're going to keep rates steady, which was what the market expected. However, they actually took back some of the future rate cuts that they've been talking about and projecting. They were going out to 2024 and 2025, saying we're likely to cut rates several times. They took those away. And the market wasn't ready for that. And so what happened was the 10-year U.S. bonds spiked, and it spiked to the highest rates since November 2007. Look at that chart. It's just crazy that that's where we are, 2007. Some of you were still in school for that. So I remember it. I remember it well. But this is where we are in this market. We've got very high interest rates, especially compared to the last 15 years. It's why the market is now starting to have a lot of trouble going forward. Because remember, the higher that those interest rates go, they're competing for investment dollars. And when you're looking at the stock market, that looks a little bit dicey, and you're looking at bonds that are at 4.5%, 5%, all of a sudden, more of that money is going to go into the bond market, which is why we're seeing the stock market fall on these higher rates. We talked about the FOMC meeting, but let's go through some of the other news here. And I think there's only one that I want to talk about. It is the Philly Fed. Now, last month, the Philly Fed turned positive for the first time in like 17 months. Look at this. It is flat back over and is all the way down to negative 13.5. The economic news is holding up fairly well. Take a look at that unemployment claims. People still are fully employed. So we have this situation here where the economy is still doing pretty well. People have jobs, people are spending. However, we're starting to get more worry again, just like we got at the first of the year when people were worried about recession. Then when the recession didn't come, the market got all excited and we ran in May, June, July, and here we are back to being worried about possible recession. The market hates uncertainty, and that's what we're seeing here. Let's take a look at last week's trades. Last week's trades worked out really well here, but let's take a look at the first one, FedEx. Now, we had a 250, 260 bear call spread on FedEx. FedEx had some earnings, and it did jump. So this is not what we want to see here on a bearish trade. But here's a nice thing about options. This is a $10 bear call spread, and it's all the way out till October 20th. We like to position size everything at Maverick Trading for max loss, so we never have to decide when we're going to get out or if we should get out if it goes against us. We've predetermined that, hey, this is the most we're going to lose, and we position size for that. Another trader would be forced out. They would have to make a really hard decision up here at $269 when it's ripping their face off, saying, oh my gosh, I got to get out. And that's what happens. People panic, they get out, and then it comes back down. And surely a couple weeks later, it's back down below 250. Look, we don't know if that's what's going to happen, but that's the beautiful thing about using option spreads. Position size for max loss. You can get your face ripped off early in the trade. It doesn't matter. You position size for max loss. We still have 4 weeks to go on this trade, and it could easily come back down to 250. So FedEx is not looking great at the moment. It was up about 2.5% for the week. We also had a Las Vegas Sands short. Corey walked you through this. He said what a beautiful low base this is. And sure enough, it tumbled. And it tumbled over 6%. So this trade is looking really good on the bearish side. Another bearish trade we had on was AMD. AMD also fell just under 6%. So look, lots of bearishness out there. We were already leaning to the bearish side a little bit, not a lot. We'll take a look at all the charts, and it's now telling us to lean even further on the bearish side. And the other trade I want to talk about is Barrick Gold. It was starting to look like it was getting a little bit better. We didn't get very bullish on this. This is a very, very slight bullish, but mostly sideways trade right around the 1650 area. And you can see that it held in for the week, but had a really nasty candle on Friday. Look, it's nothing to panic about. This trade still has more time. This is a diagonal call spread. So if we do break down below 1550, I think you've got to exit, take that one off the table, and move on to the next one. All right, so let's get into the current market analysis. Let's take a look at the numbers for the week. And here we have the numbers: Dow down 1.8%, S&P down right around 3%, the Q's down 3.5%, the Russell down 4%. So as you can see, the riskier stuff is getting punished more and more than the safe stuff. Oil actually was only down 1%. That's a really solid week for oil. Gold basically flat. Let's really take a look at these charts. Now, I really want to focus in on where we were just a week ago. Just a week ago, I was looking at this. I've been on vacation for a month, and I left right around here and came back right around here. And it was in this really nice sideways area, and the market didn't do anything. And this is where we were. Moving averages had flattened out, and we had identified, okay, these levels we're most likely going to stay in between here. And I even said I wouldn't be surprised if we stay in this range for the next couple weeks or maybe the next couple months. Well, the market did not listen to me, and it said, you know what, I don't think so. And here we are breaking down below this support level. We've got 2 support points here. We have now clearly at least broken out of the sideways trend. We might get a little bounce up, but I think anything should be sold. We are now having moving averages starting to tip lower. This is the start of a possible move down. Now let's talk about where we are in the year. We've talked every single year, and this year we talked about the worst 6 months of the year, as far as seasonality goes, is September 1st to October 15th. Last year, we had a big sell-off in this period. October 15th was literally the bottom. I think we're in the seasonality pattern where we are going to get some more weakness. So I don't know if we keep falling for the next couple months. I guess we'll find out. But I do think that we're in this period of seasonality where the market usually freaks out. So I do think looking forward for the next couple weeks, I think we are likely to see some intensified selling out of the market. If we take a look over here at the Qs are holding up a little bit better, just a little bit better. As you can see, they're not quite there yet. But look, all the momentum is to the downside. It just does not look great here. We're getting some lower highs. This is not a bullish chart. The best you could say was this is slightly bearish. That's the best you could say. And if you were super bearish, you'd be licking your chops saying, hey, I think we're going to break down and have quite a fall here. The NASDAQ is still up over 35% for the year. We definitely have some room to give some money back. And let's take a look at the bond market, because this is the story. We've been talking for the last couple of weeks that the bond market is in the driver's seat. Whatever the bond market does, the stock market is going to follow and do the exact opposite. And this week we had breakout. Now I want to put up a chart here of the long-term range of the bond. Take a look at this chart. Look at it all the way back to 2007. That's the last time we were up at these rates. That's just astonishing here to look at this chart and just see how low interest rates were for so long. We're back to the 7.5% mortgage rates that we haven't seen for well over 15 years. So the market is definitely having some stress based on the interest rates. And if interest rates continue to go higher, I'm telling you, this market is going to continue to stay under pressure. This is the key to this market, interest rates.
Have you been trading in the markets for at least 2 years? Are you starting to see some decent progress? Is that progress so small because of your limited account size? Maverick Trading is a prop firm that provides capital to profitable traders. You trade a minimum $25,000 account and keep 70 to 80% of the profits. After 2 consecutive profitable months, you move to a $50,000 account. As you keep progressing, you will be able to trade 6 and 7-figure accounts. To learn more about trading for Maverick Trading, either click on the Apply card in the top left, click Apply at the end screen, or click the link in the description to watch our recruiting video that explains more about Maverick and prop trading. If you like what you see, apply for a position and meet with our recruiters. Are you our next trader?
So to wrap this up, the markets are now bearish. Now you could be at a -1, you could be at a -2. You can't be at a 0 and you can't be at a +1. You just can't. Now you could hope that we were, but that doesn't pay the bills. Now let me tell you a little bit about how I feel. I don't feel that bearish. I look around at the economic numbers. I look around at, restaurants are still busy. Everyone's still doing their same thing. So I'm not looking around saying, oh, there's a recession that's imminent. Here's the problem. The stock market charts are telling me to get more bearish. I don't feel like being bearish. I don't feel bearish here. But the market is telling me to get more bearish. One of the things I'm the most proud of as a trader is I no longer trade my opinion. I only trade the charts. So we can all sit down, have a drink, and you can tell me how good your business is doing or how good things are. The charts are telling you, hey, you better get a little bit more bearish because that's what it's telling you to do. Looking at these seasonality patterns, we've been talking about this. I think we are going to see some softness through October 15th. What happens after that, I don't know, but we are just right in this period where it seems like almost every year we get some freakouts. And we already talked about it. The bond market is the key here. Higher bond rates mean lower stocks for sure. After a ton of news last week, we don't really have any major news this week. I do want to point out the one report I think is going to matter. It is Friday. It is the PCE price index. This is the Fed's favorite inflation index. And if it is hot, it could definitely put some pressure on those interest rates to go even higher. So let's update where we are here. We were at like a -1, maybe a -0.5 last week. Here we're down to a -2. Now you might say, hey, Rob, I want to see if we might bounce on the support line. We didn't clearly break it on Friday. Okay, that's fine. You better at least be -1. And if we do get that bounce, I think you are licking your chops for a bear rally to short into. So we're at a -2 here. And I think this week is going to be a negative week. I do think we are looking at a negative week this week. Now that's the general overall market. Let's go in and take a look at the sectors because there was a huge move in sectors this week. If we take a look at the raw numbers, we can see the worst sectors were real estate and consumer. Now we know why real estate, higher interest rates is going to really put some pressure on the real estate business. That makes sense. Consumer was down even worse. So people are thinking, okay, maybe higher interest rates, people using credit cards to buy things, maybe that's going to put a crush on it. Materials were also weak. What held up the best? Healthcare. But look, this is a defensive sector. So you would expect defensive sectors like healthcare and utilities to actually do better than the rest. So I don't think you can really point to these two and say, hey, they're doing great. They're supposed to do great. So they're supposed to do not as bad in this environment. As you can see here, everything else is right around what the market did. I don't see anything that's really outperforming the market as far as last week. You either did what the market did or you did a lot worse in real estate and consumer. But let's break down all these scores this week. So we've got real estate. Sorry, this is utilities. Last week, we were starting to get back out of bearishness in utilities. And you can see we got up to this point. We rolled over. Look, we are right at that 20-period moving average. But we are weakening here. So I'm going to give this a -1 on utilities. So slightly bearish. Coming over here to the communication services. This has gone from like a +1 in a week to a -2. We're now down below both of the moving averages. These moving averages have flattened out, but we're clearly below, and these candles are not great candles. Rallies and then falls, rallies and then falls. Closing at lows, telling you that the sellers are in control here in communication services. Real estate looks atrocious. We have now broken down below the lows. Now we're going to be going through these charts, and I want you to notice the stocks that are making new lows over the last 3 months. The sectors. These are telling you this is where the weakness is. So real estate is at a -3. Very intense selling here on real estate. Coming over here to industrials. Same thing. We are lower. We're the lowest point in the last 3 months. This is also a -3. Just intense selling here across the board. Next up is healthcare. This is also breaking down, and it is lower than it was just this last little rally. So these are the sectors that are actually the worst. They're making new couple-month lows here where some of the others aren't. So like financials. Look, financials looks terrible. It looks absolutely terrible. Look at these candles. This is nothing but selling all day long, and at the very end, they close on their lows, telling you that the bears are overwhelming any buying that's out there. That being said, we haven't made a new low, so this looks terrible. It just doesn't look like the worst. I know that's about all you can say about the financials. Here we have the consumer. And in the consumer sector, we haven't yet made a low. It looks atrocious as well, but when you compare it to something like real estate and industrials, it's not the worst. It's still terrible, but it's not the worst. We come over here to technology. We're going to say the same thing. Boy, this looks terrible, but it's not the worst. So we've got to give that a -2. It's not the worst. It's market perform. The market's at a -2 at the moment. But then we come over here to materials and we say, oh my goodness, we blew right through that last low. This is clearly one of the weakest sectors. We're at a -3 on materials. And then we come over here to energy. And this is the only thing with upward sloping moving averages. So right away, that looks decent. But look, we pull back. We're right in between moving averages. This is a +1. It is mildly bullish. And at the moment, there is nothing but selling here. We are closing on lows, so we do expect energy to go a little bit lower before it tries to find a bottom. This is where we were last week. So as you can see, that's what I was talking about. We were leaning to the bearish side, but not too heavy. You know, we had 3 sectors at -1, one at +1, one at +2, one at -2, and the rest in the middle. So as you can see here, this is just a slightly bearish lean. Take a look at what happened, and this is where we are right now. As you can see, we have leaned very far to the bearish side, and other than energy, it's just a matter of how bad is it? Is it a little bit bad or is it a lot bit bad? So let's go in and take a look at some possible trades in some of the best looking sectors for this week. Many people are unfamiliar with exactly what proprietary trading is. Prop trading is when a private firm hires traders like you to trade with their capital. Those traders are paid a percentage of the profits that they generate for the firm. Profitable traders are awarded higher and higher levels of capital to trade so they can take bigger positions and make more money. We've been in business for over 25 years, and we're one of the oldest prop firms based in the USA. If you would like to look into being a trader for Maverick, look in the video description below and click on the trader position to apply. Let's start out with utilities. Now, if you remember utilities, we had a -1, which means it's still a little bit bearish, but it is actually the second best sector. So when we look inside this, we say, okay, we want to have some bulls, we want to have a lot of bears, but we want to have some sideways stuff. I think this is a great place to go hunt for some sideways. Here we have NRG energy, and you can see here when you take a look at this chart, we have a chart that is going very, very slowly to the upside. We've had a pullback. Okay, so here we are. We're right around this 38 area. So the big question was, okay, where do we open up our butterfly? I've chosen to open up a 36, 38, 40 butterfly. I think this is going to be a little bit negative. Again, the sector's a -1. I want to be a little bit bearish, not a lot. This is a mostly theta trade. You could easily do the 37, 39, 41. Or you could do a 39, 37, 39, 40 broken wing butterfly if you think it's going to be a little bit higher. I want to be just slightly bearish on this one, but get a whole bunch of theta looking at the October 20th, 36, 38, 40 butterfly on NRG. All the other sectors are pretty nasty here, and real estate was a -3 amongst the worst. Here we have VTR, Ventus. Now take a look at this one. Big fall here on the charts. We have this big fall, and then we get this bear flag. Now a bear flag is just the opposite of a bull flag. When you have a very strong stock, then it has this little downtrend, and it's usually an ABC wave. For any of you Elliott wave people here, it usually goes like this, and then you get a breakout to a new run. This is just the opposite on the downside. So we like this one, and we think that 40 is a good target here. So here we have the October 20th, 40-45 bear call spread. Pretty simple trade here. It's right above the midpoint, so you're going to be getting in about probably 260 in a credit with 240 of risk. You have a slightly better chance than 50-50 to be profitable on this trade. This is VTR in the real estate sector. Industrials also looked atrocious at a -3. So we want to focus on the weakest stocks here. And here we have Delta Airlines. All the airlines look really terrible here. And you can see they've looked terrible for a long time. Fall down, bounce, rally, fall down. We had a low base here. We just broke down out of this base. Look, we might have a rally here over the next week or two. That's fine. We just want to play a very simple bear call spread. And we're going to do a 36-38 bear call spread. And just say, look, we think it's going to be lower here over the next 2 weeks. That's it. That's it. We just open this up. And just like we talked about with FedEx, let's say this thing jumps up next week early. Big deal. We've got a lot of time to let this thing work its way lower if the market works its way lower as well. Moving into tech. Tech was a good place to look for some shorts. Here we have RUN, Sunrun, in a low base. And you can see here, this stock has been really weak. I mean, so weak when the market was strong in July and August. The market took a dump. This thing just based because it was so weak that everything else got some selling. Here we are. We're now breaking down to the lower end of this base. We're looking at the 12-13. This is a very simple $1 bear call spread. This is about an 8% range on this $12 stock. You know, a $1 spread is about 8%. So basically, this stock needs to go down about 7 or 8%. If it does, we're going to be looking at a really nice gain here on this. You also could take a look at the 15 puts. This is the trade that I entered, the 15 puts. I think this thing has the potential to make a run down to the 10 or 11 area if we get a lot more selling here in technology. We've got a nice long low base that should have some good power behind it after a rest. And last, energy was our #1 sector at a +1. We still think it's got some selling here. So let's take a look at a +1 type of trade here. This is Marathon. And you can see that the sector has pulled back, but Marathon did not pull back. Marathon high-based. Now we're going to be looking at a diagonal call spread. So buying the monthly Octobers, selling next Friday's 155. Now I want you to take a look at this. This is a 150, 155 diagonal call spread. This is the same as someone doing a $15 call and selling the 1550 against it. Whenever we play these higher price stocks, we got to really just adjust this down so we understand it. This is closer to a horizontal spread than a diagonal spread. So a diagonal spread is going to have a risk graph that looks like this. That's going to be a diagonal spread. A horizontal spread has a risk graph that looks like this. So we're going to be putting this on as closer to a horizontal spread than a diagonal spread. Now we're still going to be a little bit bullish, but it's probably going to look something more like this. So we're not asking it to go up a ton. 155 is the top. If this thing breaks out and takes off to 170, we might actually make zero off of this. We might actually lose a little bit, but we're getting a lot of theta here and giving ourselves the opportunity, if this does work its way higher, we can still be profitable on this. Again, this is a +1 type of trade. We're not asking it to do a lot. We're just asking it to not tank. We just don't want it to tank below this 50-period moving average. Then it's going to be a loss. But as long as it stays up above the 150 area, we're very, very happy to just have that theta bleed away and put some profits in our pockets. All right, Mavericks, if you guys have some trades you want to share with the group, you know where to go. Log into the website, go to the members area, jump on that forum. We love to see the discussions and to see all of our traders helping each other make some profits. Let's go ahead and wrap this up. It's bearish. I can't be more clear about that. Look, I don't feel bearish. I've been looking at this market saying, hey, I think it's going to be sideways. I've been very vocal with it, saying, hey, it's sideways. I think we don't go anywhere for a while. You have to sometimes admit, oh, I was wrong. It was going sideways for a while, but now it's not. You have to trade the charts, not your opinion. You can have some drinks with your friends and talk about your opinions all you want, but with your money, the chart is telling you be at least a -1, if not a -2. And if it gets worse next week, you could even go to a -3. There is no place for a +1, +2 bullish leaning portfolio at the moment. The charts are not telling you to be there. So look at where you are and make any adjustments you need to. I really like this seasonality pattern here. I think that you can look at where we are and say it's highly likely we get more weakness till October 15th. After that, we'll reevaluate it. We'll look at some things. I don't think we're going to have a big crash like we did in 2018, where we crashed 25% from October to the end of the year. I don't think that's going to happen, but that's my opinion. If we look like that in late October, I'll change my mind and be like, hey, you know what? Looks like we are going to fall a little bit more. But I do like this window of the next 3 weeks of leaning further on the bear side. I think we've got a lot of things helping us out if we're more net bearish than anything else. And as always, focus on the sectors. The sectors are telling you where the money's going into and out of and where it's the ugliest. Thanks for joining me, everyone. Have a great weekend. Happy trading, everyone. Goodbye.